and welcome everyone. So today we'll be looking at SBR. As this is the first class, we will be having an introductory section where we talk about the exam, what the exam entails, what ACCA tests in the exam, what is expected of us, so that we have the right mindset as we go into the course. We'll be looking at the questions, the nature of the questions, and how they are scored. Following that, we'll be looking at the conceptual framework, and after that, we'll be looking at IFRS 15. So for the first part, understanding the SBR exam. Now, what does the SBR exam test? The SBR exam is not like your earlier papers where it's just knowledge that is being tested. Here, the major thing that is being tested is your application, your ability to make strategic business decisions. So for the SBR examination, you have to put on your practical hats. You have to imagine yourself working in the workplace. You have to imagine yourself for every question that is asked. Imagine that it is the MD or is the CFO or a board director that is asking you that question, and you respond the way you will respond to him, right? So it's your ability to make strategic business decisions. It also tests your ability to apply concepts and theories to real life scenarios. So they're not going to ask you straitjacket questions like, what does IFRS 15 say? Or what does substance over form mean? That is not going to be asked in SBR directly, but they want you to be able to apply your knowledge of those concepts, of those principles, of those theories within the corporate reporting environments. So that is the kind of mindset that we should have. Now, if you look here, this document is from the ACCA Hub, and here they've said more marks will be allocated to written answers than numerical answers. So that already tells you that what they are looking for is not just debit and credits. They want you to discuss. They want you to defend your answer. They want you to analyze. So please, I want us to keep this at the back of our mind as we go into the course. More marks will be allocated to written answers than numeric answers, and I will explain in detail as we go along. Also, another key thing is that brief narrative answers may not meet the requirements. So this is not an exam that you go into the hall and write just one line and think that it is okay. You have to be detailed while mindful of time, but you have to be detailed in the kind of responses that you're giving to the examiner. Okay. So, and let me even read this in detail. They say brief narrative answers are unlikely to meet the requirements of the question, even though the numerical content may be correct. Your answers should be detailed. This is not from me. This is directly from ACCA, right? I can drop the link to the document so you go and verify. So you have to be detailed in your answer, even though you get the debit and credit, you get the calculation of fair value, whatever that is being asked, and you don't give proper detailed narrative answers, you can fail the exam. So let's keep that in mind. And then lastly, some questions will require you to adopt a stakeholder or investor focus when answering. So it would usually be implied in the question. So you may be asked a particular question and you have to look at it, okay, from the point of view of the investor, from the point of view of the people who will be reviewing the financial statements. That is what SBR is. So it is not like your standard financial reporting exam. Here you are analyzing, here you are discussing, here you are explaining things and to the person who is listening, to your stakeholder. And you will know who your stakeholder is depending on the context of the exams. So now if we come here, we'll look at this pyramid that explains SBR. Now for SBR, the base the basic knowledge to have, the basic thing that guides financial reporting is the conceptual framework. Now, the conceptual framework, we'll look at it later, but it guides the way standards are being set. It guides the way everything is being accounted for so that there is consistency in what we do. It analyzes the elements of the financial statements and gives you the criteria for recording any transaction as an asset, as a liability, as a revenue, as an expense, whatever it may be. So that is the basis of financial reporting, the conceptual framework. Now, on top of this, we now have the detailed knowledge of the IFRS standards. So the IFRS standards usually build on the conceptual framework. And then you now have the different reports that you have, which is now going to be either your financial statement, your sustainability report, whatever it is. And all of that is guided by professionalism, judgment, and ethics. And all of these are tested in the SBR exams. Are we clear up to these points?
Yes, we are.
Okay, thank you. So moving on to the exam proper. So SBR is a 3-hour, 15-minute exam with 4 compulsory questions. You have to attempt all 4 questions. Section A is made up of 50 marks. The first question is what 30 marks. The second question, 20 marks. Section B comprises of 2 questions with equal marks. That's 25 marks each. And within each of these, there are professional skills marks. So professional skills mark it's like soft skills. I need to mute. There's someone okay. Okay, thank you for muting. Okay, so within each of these questions, we have professional skills marks. 4 professional skills marks within the exams, which tests your professionalism. So they look at how you've structured your answers. They've looked at the way you've applied judgments, and that is what this 4 marks is a professional skills marks. And usually they would let you know what the professional skills marks is in the question. As we go ahead and we look at past questions, we'll be able to identify that and see what they are. So for 3 hours, 15 minutes, 4 questions, the recommendation is to allocate approximately 1 minute, 1.8 minutes for each mark. So for question 1, you can spend about 55 minutes there. For question 2, about 35 minutes. Question 3 and 4, 45 minutes each. So if you add that up, you will still have about 15 minutes to go over your work and everything. So this is the allocated time. So if you see that you're in question 1 and you're already exceeding 50 minutes, 55 minutes, just move to the next one. Make sure you've at least done something in each of the questions. Time yourself. As we go ahead, we'll practice timed practice to know that, okay, we can actually solve the questions within the time constraints during the examination. So this is just further on what the exam structure will be like. Question 1 is always examines group accounting. It always is on group accounting. And so you're not doing any consolidation here, but they will give you different scenarios, different issues where you will have to discuss either the correct accounting treatments and all of that. So that is what question 1 is. Question 2, which is what 20 marks, always tests ethical implications of an accounting issue. It can be any accounting issue. It can be revenue, it can be share-based payment, it can be any of the standards. But what they're testing there is always ethical implications. And now section B can be a scenario on any of the standards. Any aspect of the syllabus can be covered under section B. So, the next thing I want us to look at are the frequent verbs used in SBR exams. So there are some questions where you would see explain this, assess this, discuss this, justify the use of IFRS 15, or justify the recognition of these assets. So all of these things, what does it mean when you see those, when you see those type of questions? Again, this is from the examiners decks, ACCA examiners, and they've said when they say explain, what they mean is make an idea clear. So you show logically how the concept is developed. So you're starting from the beginning, you explain, logical explanation. So if there's one thing I would recommend is don't ever assume that your examiner knows something. You explain everything. So if, for example, you have a question that says a revenue-based question, and you're asked to justify the recognition of revenue, don't imagine in your head that the examiner already knows IFRS 15. The standard. Don't imagine that the examiner already knows the 5 steps in recognizing revenue. Don't imagine it. You have to put it on paper. You have to type it into your response sheet. So you start from the beginning. Is this a contract? You say, okay, the contract was entered by both parties. It was signed, this. So this makes it a contract. Check. The transaction price can be determined, this. So you have to write it all out. Don't ever assume. So that is explaining. You explain logically how you arrived at a particular decision. Another commonly used verb that they use is assess. So you can be asked a question and say, assess the impact of the directors or of the CFO's decision to recognize the share-based payments, right? So what are they saying you should do here? They're saying you should judge it. Judge the worth. What's the worth of that decision? What's the importance? Evaluate it, estimate the nature, quality, or the significance of that recognition in the financial statement. That's what assess means. So you have to do all of this. So if you see all of this, you will see that there's nothing numerical here. You have to put in narratives, detailed narratives explaining the steps to arrive at a particular number, at a particular figure that you have in the exam. Justify. This is pretty straightforward. So you have to show adequate grounds for a decision or a conclusion. And you have to relate it to the context of the organization or using supporting evidence. So this is another critical point that I think we should spend time on, because in time past, examiners have said that students just state concepts and they don't relate it to the scenario. They don't relate it to the organization, and that won't earn you marks. So you need to always relate the arguments to the context of the organization and to the supporting evidence from the scenario. And it's not very difficult. So if you are explaining that, for example, that the recognition of the share-based payments will ensure faithful representation of the dealings of the company, for example, right? So you put if there's an exhibit that has been included that talks about it, you just reference it. You reference it to say, okay, following exhibit this or following the decision of the board of directors to do XYZ, the representation or including this in the financial statement will result in faithful representation of the affairs of the organization. That way, you've not just mentioned an element. What you've done is you've related it to the supporting evidence. You've related it to the context of the organization, and that will earn you full marks. So that is what you should do here. So there are other verbs that are used in questions: analyze, calculate. Now, all of these, we need to know what they are. But the general advice I would give here is use the marks allocated to know the extent of your discussion. So if there is a question that you should explain the use of IFRS 15 in recognizing revenue, and that question is 10 marks, for example, just putting debit and credit won't earn you 10 marks. So make your response detailed enough that you know will gain you 10 marks. Include an introduction. Restate the issue. So what exactly is the issue? You restate it. Okay, what does the framework say? You state it. What does IFRS 15 say? You state it, and then you state that based on this, revenue should be recognized as follows: debit this, credit this, and you put a conclusion. That way, you know that you have enough narratives to earn you 10 marks. If it's a question that just has 4 marks, don't spend time writing too much. Go straight to the point. You can put a small narrative, and then you put your debit and your credit, the figures in there. You put the implication, and that is all. So always use the marks. If you don't remember, okay, what does illustrate mean? What does summarize mean? What does justify mean? If you don't remember all of that, use the marks allocated to the question to imagine what the examiner expects from you. So that's all for the beginning part of the SBR exams, understanding it. Is there any question at this point? Okay. If there are no questions, we're moving to the next section, which is the conceptual framework for financial reporting. Now, the conceptual framework sets out the concept, the fundamental concept for financial reporting. It is not a standard. It's the framework on which all standards are built. So if a new standard is to be developed tomorrow, is to be issued tomorrow, they would have to consult the conceptual framework. What does the framework say before they develop that standard? And why do we have the conceptual framework? It helps to ensure that the standards are consistent. So the definition of assets is consistent across all standards. It also helps to ensure that similar transactions are treated the same way. So this helps comparability of financial statements, so that when you pick a financial statement from Nigeria and you pick another one from Egypt, for example, it's the same thing. If you pick a financial statement from one industry, you look at another one from another industry, the fundamental framework is the same. The definition of an asset in financial services is the same thing as the definition of an asset in manufacturing. So that is why the conceptual framework is there. And it's also there to provide information for different stakeholders. Now, there are different people who use the financial statements. We have investors, we have lenders, we have creditors, the public, the general public as well. So there are different people who use the financial statements, and they are all looking for different things. What an investor looks at when they pick the financial statement is different from what your creditor or a lender will look at when they pick your financial statement. It's also different from what your employees will look at. So how do you assure these people that the information that they need is included? It is guided by the conceptual framework. So the conceptual framework provides guidance on areas where no standard exists. It prevents creative accounting because it provides the fundamental concepts. So even if there's no standard for a particular transaction that your company is having, you can use the conceptual framework to recognize it. It also ensures that financial statement contains information that is useful to users. And lastly, it helps all parties to understand the financial statements. Now, this is a point. If you are asked a question in the exam, even if you can't recall the specific IFRS standards, what did it say? What am I supposed to do? You can use the conceptual framework, and at least you will earn a few points. Once you apply the principles, the definitions, the recognition criteria and measurement basis, you should be fine. But that doesn't mean you shouldn't study the standards. You should. In fact, you must. But the conceptual framework is very useful because if you forget any standard, you can apply the conceptual framework and arrive at a reasonably correct response. Okay, so to revise the conceptual framework, what is the objective? The conceptual framework defines the objective of financial reporting as to provide useful financial information to existing and potential investors and other stakeholders. So when you have any financial reports, the primary objective is to provide useful financial information. So let's call this number 1. Also, it says that the information presented in the financial report should be sufficient to assess future cash flows and stewardship of management. So you want to be able to say, you want to be able to see sufficient information that would allow you to say, okay, what will this business be in the next 1 year, in the next 2 years? The future cash flows. So you can look at the assets or you can look at the receivables or the liabilities and foresee into the future to say, okay, how would this business be? Investors use that information a lot. It also helps to assess stewardship of management, right? So let's call this number 2. So the next thing that the conceptual framework talks about are the fundamental characteristics, the characteristics of financial statements. It must be relevant. It must be faithfully represented. So what relevant means is it has to be predictive or confirmatory. So it has to be relevant to the stakeholders. It has to faithfully represent what happened during the year or during the period. So it has to be complete. It has to be neutral, not biased. It has to be neutral and it has to be free from error. So relevant, faithful representation. And there are other enhancing characteristics which has been stated. It has to be comparable. It has to be verifiable. It has to be timely and it has to be understandable. Now, comparability, how does this come into play? If there is a particular transaction, let's say in the previous year, let me use foreign exchange gain or losses. Let's say in the previous year, it was recognized through profit or loss because there were a lot of gains. So the company recognized this. This is just an example. The company recognized it as income. And this year, because the exchange rate is now bad, and there are a very high revaluation losses, you now decide that, no, I can't recognize it in P&L. It's going to affect my profitability, my bottom line. Let me take it to OCI. That's not allowed. You have to be consistent so that there is comparability. Where were we last year? Where are we today? Right? Everything has to be done the same way. So if there is a question and it's saying that the accountant treated it in using method A last year, but this time around wants to use method C, and they're asking you to justify or to analyze the accountant's treatment of the transaction. So in there, you will put in there that it violates the comparability characteristics of a financial statement because the standard has not been applied consistently. You put it there that also it doesn't faithfully represent what has occurred. So that is how all of this will come into play when you're answering questions. If you know this, understanding this will help you with the narratives, with the details that you need to put in when answering any SBR questions. So next, the elements of a financial statement. We know this: assets, liabilities, equity, income, expense. When do we recognize them? So for assets, they are for present economic resource controlled by the entity, which are likely to produce, which are expected to produce future economic benefits. So anything that is controlled by the entity that would have benefits for the entity, economic benefits, is an asset. Liabilities, their obligations to transfer an economic resource which arises from a past transaction. So someone has done something for you. You have an obligation to pay. That's a liability. Equity is the residual interest in the assets of the entity after you've deducted all the liabilities. So it's asset less liabilities. We have income. Income are increases in assets or decreases in liabilities that results in an increase to equity. That's very, very key. That results in an increase to equity. So if there is an increase in asset, decrease in liability that would increase equity, it's an income. And then the expense is the opposite of income. Now, why this is important is there may be scenarios that you may not be familiar with. Maybe you're not familiar with the direct treatment of the standard. Just ask yourself, this particular transaction, does it lead to an increase in assets or decrease in liability? This decrease in liability or this increase in assets, is it also going to result in increase in equity? Just think about it logically and you'll be able to answer any question in the SBR exams. Okay, so next, recognition and the recognition criteria. When are items recognized in the financial statements? 1, if it meets the definition of an element, that's these elements that we've looked at, assets, liabilities, equity, income, you recognize it. If it does not meet, you don't recognize it. 2, when it provides relevant information. If something doesn't provide relevant information, you don't recognize it in the financial statement. And also when it can be faithfully represented. If you cannot determine the cost or the value of a transaction faithfully, you don't recognize it in the financial statement. So the recognition. When do you recognize an item from the financial statements? Number 1, when the entity loses control of the assets or when it has no present obligation for the liability. If the liability doesn't exist anymore, you derecognize. If you've lost control of an asset, you derecognize as well. Okay. So for measurements, how do you measure what is on the financial statement? There are 2 measurement bases outlined in the conceptual framework. We have the cost method, the historical cost, which is often used for fixed assets. And we also have current value. So this can be fair value, value in use, current cost. So these are the 2 measurement bases. Sometimes you may be asked in the question, when do you use historical cost? Or you should justify the use of the measurement basis in the exam. So it's important to know what they are. Now, when selecting a measurement basis, relevance is maximized if the following are considered: the characteristics of the asset or liability and how the asset or liability contributes to future cash flows. What does this mean? This simply means that think about which measurement basis give the most useful information to the users of the financial statement. That is what this means. Which one will the users of the financial statement prefer? Historical cost or current value? What will they prefer? So if you are looking, let me use an example of a USD balance that is being held. So you know USD balance, if it's a Nigerian company, let's imagine a Nigerian company has USD balance, right? And in the books, you have to translate that USD to Naira. So USD to Naira, you have to translate it. At the end of the year, you have 500, or let's say you have $1,000. And in the books, what you have as the Naira is, let's say, 500,000. But at the end of the year, you notice that the CBN exchange rate was 400,000. Whatever happened that related to this, let's not even think about it now. If you are the investor, what will you prefer to see in the financial statement? 500,000 Naira or 400,000 Naira? Most investors, can someone respond? I don't know if someone is here. If you are an investor and you have a balance in your account, a USD balance that's been translated to Naira, the actual USD is 1,000 USD. But the accountant somehow has a balance of 500,000 at the end of the year. But the CBN rate is 400 Naira to a dollar. What will you prefer to see? 500,000 or 400,000? So most investors would prefer to see the actual cost. What is actually the value of the money that is left? What is actually the value of the money that I have left is 400. Because if I am to exchange that money for Naira on that day, how much will I get? I'll get 400. So in this case, you are using current value. So for every question, you have to ask yourself, what gives the most useful information to the users of the financial statements? And that will be the answer. So let's take another example. If you have office building, if you have a building, you're a company, you own a building and you use it for your work, like as the office, the corporate headquarters. So your staff come in, you work from it and all of that. How would you recognize it? You recognize it as historical cost and you depreciate it, right? Because that's what the standard says. It's an asset that you use and economic benefit is likely to flow to the entity. You are using that corporate headquarters to work. And as a result of that, you expect income to come in. So you recognize it as an asset using historical cost, right? Because it contributes to cash flows indirectly by housing the staff, by keeping the people that would work within the building. What if that building, you don't stay in it, but you rent it out? What is the value? What's a measurement basis will give you the most value? Let's say you don't know about the IAS or the IFRS, sorry, the IFRS on investment property, right? We've not looked at it yet. So let's say we don't know anything about the IFRS on investment property. But how do you think we should recognize investment property? Should we recognize it at cost or should we look at the market value? What would add more value to you as a user of the financial statement? Is going to be the current value. Because if you are going to rent that building, you're not going to rent it for what you rented it out for 20 years ago or the cost that you built it for 20 years ago. So historical cost doesn't make sense there. What you use is current value, right? So sometimes in the question, you may be asked, discuss an appropriate measurement basis. You may be given a scenario and they will ask you, discuss an appropriate measurement basis. And you have to discuss. So you will say, you will have to justify why you are using historical cost and not current value, or why you are using current value and not historical cost. So this understanding would help to answer that question, even if you don't have knowledge of the specific IFRS that is being referenced. Okay? All right. So if it's an asset that is used in normal operations, you use cost basis. If it's something that is held for trade or for sale, you're using it for rent, you use the fair value. That's the current value. If it's a liability, it's a short-term liability that is being presented in the exam, what will you use there? You use cost, because it is very, very short term. So the cost is unlikely to change significantly within 1 year or within 6 months. So you look at the scenario, you look at the time frame given in the scenario, and you justify why it should be cost basis. If the liability is market sensitive, you use the fair value. So if it is an investment, for example, you want to look at what is the fair value of that investment. Okay. So finally, presentation and disclosure. So we know the different financial statements. The statement of profit and loss is the primary source of information. We also have the balance sheets. We also have the cash flow statements, right? So that is the presentation and disclosure. Sometimes there may be questions on how should this be presented. Should this be presented on the statement of profit or loss, or should it go to OCI? So you have to justify what it should be. If the income or the expenses that is referenced in the question arises from changes in current value, then it may be appropriate to recognize it through OCI, because it's an adjustment, it's something that would always change, right? Reclassification happens, but rarely. So I think for now, this is the only exception that I would like to bring out for this class. So let's have an example to see how the conceptual framework would help in the examination. So let's look at example 1. So example 1. TechCo enters into a contract with a customer on 1st January 20X5 to deliver a customized software system and provide 2 years of post-implementation support. The total contract price is 15 million. So they entered into a contract on 1st January at the beginning of the year. What are they doing? They are delivering a customized software system, and they are also providing post-implementation support for 50 million. The standalone price of the software is 40 million. The standalone selling price of the support is 20 million. That's 60 million. However, they've renegotiated the contract price to 50 million. Okay. TechCo has received the full 50 million upfront. So it's already sitting in their cash. So they've received 50 million into their cash. Requirements. Discuss with relevance to the conceptual framework and IFRS 15 how the revenue should be recognized. So what do we do here? So the exam technique I wanted to suggest is right here. So the first thing you do is identify the issue. The second thing you do is apply the framework, the conceptual framework. Then apply the standard and conclude. You always put a conclusion. It adds to your professionalism score. Always put in an introduction and a conclusion. It helps you gain additional professionalism scores. It might be just 1 or 2, but it is something. There are a lot of people who have failed SBR because they got 49. So wherever you can get marks from, grab it. Okay? So how do we use this technique to answer this question? And this is for 10 marks, right? If we are just looking at the numbers, it will not be worth 10 marks. So we have to discuss, because that's what was required. It's asking us to discuss. So they say discuss with relevance to the conceptual framework and IFRS 15, how the revenue should be recognized. So let's attempt answering this now. Okay? Okay, permit me to just share another screen with an Excel so we answer the questions. Are you with me so far?
Yes, we are.
Okay, does anyone have any questions so far?
Not for my part.
Okay. All right, so let's look at the question that we have before us. Can you see my screen?
Yes, now.
Okay. Okay. All right. So, can you see my screen still?
I think it displays black stuff.
Okay.
Yes, it's
What
fine
now?
now.
All right.
Yes. But can it be enlarged?
Okay, you can't see.
We can, but I think it can still be expanded.
Okay, let me make it bigger.
Okay.
Increase the. Is this okay?
Yeah.
Okay. Okay. All right. So I pasted the question here so that we can also still look at it, right? So remember our exam technique. We'll first of all look at the issue. You always have to restate the issue. Don't imagine that the examiner knows what the issue is. Yes, they know what the issue is. They want to test whether you know what the issue is. So what is the issue here? So if you have your Word documents, you can just put in as a template that can guide you as we go for every standard. This is what we are going to use. This is how we're going to structure our question. So let me just type it first. Issue. We're going to consider what the issue is. The second thing that we said is the question even required with reference to the conceptual framework. Even if it is not asked that you should make reference to the conceptual framework, put it at the back of your mind that you will make reference to the conceptual framework. So let's call this other section application to the conceptual framework. Okay? All right. And then it also asked application of IFRS 15. So application of IFRS 15. And then always include a conclusion. Always include a conclusion. I can see that it's going blank from my end and I don't know why.
Is it possible to enlarge the sheet, that Excel sheet? Look at the top of that sheet. You see sign in?
Yes.
Okay, let's click at this middle.
Okay, to maximize it, right?
To maximize, yeah.
Okay.
I think that should regularize it. So let's try that, Ma.
All right, no problem.
Yeah, I think it should be
It's
better.
better?
Yes.
Okay. Okay. So, what is the issue? Can anyone tell us what is the issue here? What is the issue with this question? Does anyone want to try?
The issue is is a contract. There is a contract between Tesco and its customer, and then it's supposed to provide a customized software service and as well provide support. And then we have to show how to recognize the revenue.
Okay. But in the recognition of the revenue, there's a particular issue here. So, there are two things that is being delivered: a customized software system and 2 years implementation support. And they say the price is 50 million. So the issue, like you said, is how do we recognize the revenue, given that included in this 50 million, there is a 2 years post-implementation support. And you know how accounting works. So you have to recognize your revenue or your expense in the period to which it relates. So if you recognize the entire 50 million, you've recognized the cost or the revenue for these 2 years post-implementation support. And that is not correct. So that is the issue here. So in your definition, in your sheets, in the SBR exam, you will be given worksheets. You'll be given Microsoft Word and you'll be given Excel, sometimes spreadsheet, depending on what the requirement is. So in your sheet where you've put in your headings, issue, application of the conceptual framework, and all of that, you come and you start typing. So you put here, TechCo has entered into a contractual relationship to deliver what now? So this is you restating the question, really, to deliver a customized
shirt.
Yes, software and 2 years
of support service.
2 years, let me just put support service to save time, but you put it there. The issue is whether to recognize the 50 million, we can call it the bundle cost or the bundle revenue of 50 million in the first year or upon payments. Let's use upon payment. Upon payment. That is the issue because that's what we want to determine. So what are we supposed to do here? So this issue in itself, by the time you state it, you can get 1 mark just for stating the issue. You've not done anything. And if you, I don't know if you guys are aware of examiners' reports. After every exam, ACCA examiners issue out examiners' reports and they put what they expect to see. Sometimes they put the scores that are allocated and they will tell you there for some of them that just stating what the issue is will gain you either 1 mark, 2 marks. So this is not me guessing. This is something that is done. Examiners have written it, is on the ACCA website. We'll look at a couple of them so that you understand how the examiners think. If you understand how the examiners think, you'll be able to pass SBR very easily, because your accounting might be wrong, but if you are able to explain these things, you will get sufficient points, right? So we've done our issue. We've said what the issue is, 1 point. Now, look at, let me make this small a bit. Okay. So look at this. I'm coming. Let me remove this. Okay, there is something in there.
Sorry, I just want to clarify something.
Okay.
The question says the contract price is 50 million.
Yes.
So I don't know, is it inclusive the implementation support as well, or just for the contract?
So the contract covers both the customized software and so everything is included there. I'm trying to move this to the side so that we don't keep on scrolling up and down. You guys can see, right? Can you see properly? I'm trying to.
Yes, we can.
All right, thank you. So bold, underline. You can bold, underline it in your work, in your answer sheets, right? So that it is clear, so that you will get professionalism score as well, right? So it is everything. So now, looking at this scenario, if you are to apply the conceptual framework, what are the things that you should be looking at? Now, if you remember in our slides, there are certain things that we looked at under the conceptual framework. First of all, we looked at the elements of financial reporting, right? We looked at the objective of financial reporting, which is to give information to the users. We also looked at the characteristics of financial statements, which includes relevance and faithful representation, right? So putting all of that at the back of your mind, how do you think you can apply that to this scenario? So let's start from the first, elements of financial reporting. What elements does this fit into? Are we there? Okay, I'm going to continue. So if we are there, this fits into, this is clearly revenue, right? So you can just start. This is an easy mark to get. So you can say, according to the conceptual framework, CF conceptual framework, revenue should be recognized if there is an increase in assets. This transaction for the supply of XXX, that's customized software, increases the cash assets of the company and hence qualifies as revenue. That is one. Now, the second thing that we looked at, remember, like I just mentioned, is faithful representation and relevance. This revenue that they've recognized includes 2 years implementation support. If I put that I've earned, let's say it is 10 million, that is the implementation support, post-implementation support. If I include that I've earned 10 million naira today for something that I have to offer even next year, is that correct? It is not. Even without knowing what IFRS 15 says, it is not correct. It doesn't make sense, right? So you put here, however, recognizing the full contract sum of 50 million, which includes the 2 years post-implementation support, does not faithfully represent the affairs of TechCo. So you've put in your section 2. That is all. If this has 2 marks, for example, we would have gotten another 2 marks here. We've not done any calculation, right? And another thing I want us to note is how we've related this to the scenario. So you always relate it to the scenario. Mention the name of the company, mention the business, mention the transaction, you understand? Mention the amount, anything that helps the examiner know that, okay, you are not just typing out of theoretical knowledge, but you understand what you're doing. That is what is being tested in SBR. If you know what is being tested, you know how to pass it. You know, to pass exam, there's a skill required for passing exams. So for SBR, this is the trick to passing SBR exams. Okay, so we are done with application to the conceptual framework. Next, they've told us to apply IFRS 15. We're going to look at IFRS 15 much later, so I'm going to hold this off for now. We are going to come back to this, right? And then you put in your conclusion. Usually your conclusion will tie to this. So let's just hold on this because we are going to IFRS 15 next and we are going to come back. But do we see how just knowing the conceptual framework can give us points in the exams? It can help you to identify the issues. All those verbs that you have there where they will say discuss, analyze, justify, most times you can use the conceptual framework and be fine. So you just ask yourself, this information, this thing that is being done in this scenario, is it relevant? Is it faithfully represented? Does it meet the definition of all the elements to the financial statements? Does it really meet definition of an asset, of a liability, this, that? This information, the way they've presented it, is it comparable? Is it verifiable? Is it timely? You know, you look at all these things, elements from the conceptual framework, and you put it in there. You type it in there. Okay. So let's go back to our slides. Are there any questions at this point? Okay. All right. So we are going back to our slides. We're going to look at IFRS 15. I'm hoping that the session we've had on the framework has now exposed us to our expectations for the exam, what is expected from us. Because for every standard that we look at, whether it is on assets, on leases, whatever we look at, we are always going to come back to make reference to the conceptual framework. We are going to look at it to say, did it meet the objective of financial reporting? If it did not, we include it there under either our issue or the second paragraph where we'll talk about application of the conceptual framework. Is the information sufficient to assess cash flow? Is it relevant? Is it faithfully represented? Is it comparable, verifiable, timely, and understandable? All of this is what will help you to discuss, is what will help you to analyze, is what will help you to justify. So this knowledge is very important, is the basic knowledge that is required to build on our knowledge of the other standards and to answer SBR questions effectively. Okay, so we'll be going on to part 3 of our lesson today. And that is IFRS 15, revenue from contracts with customers. So the new IFRS 15, it uses a principle-based 5-step approach to recognizing revenue. So step 1 is identify the contracts. Identify the contract. It doesn't have to be a written contract. The standard does not mandate that it is a written contract. As long as the parties agree to it, it is a contract. It's a binding contract. So even if you see a question that says that Techno and Infinix went into business for supply of this, the both parties agreed. However, there was no formally signed contract. Right? So, would you say that is a contract or not? According to the standard, it's a contract, because there is no requirement that it has to be written. As long as both parties agree to the contract, it can be verbal agreement. It is a contract. So if you see those kind of tricks in the exam, don't let it sway you. As long as there is an agreement, it is a contract. So that's the first step. You have to identify the contract. If there is no contract at all, then IFRS 15 does not apply. It is another standard that maybe would apply to the situation. If there is no contract, IFRS 15 does not apply. But if there is a contract, you now move to the next step. Identify the performance obligation. So this performance obligation simply means the thing that is to be done. So what should be done, or what should be delivered? Is it a good? Is it a service? What actually is being done? So you need to identify the performance obligations. And most times you see more than one. Like in the example we just saw about TechCo, right? So here, there's a contract. And what is the contract for? Is to deliver a customized software system. This is a performance obligation, and provide 2 years of post-implementation support. This is another performance obligation. So here in this question, we have 2 performance obligations. So that is what this step is. You need to identify what the performance obligations are. And number 3 is determine the transaction price. How much is the contract? Like the entire contract. How much is the contract? That's what this transaction price is. So when we come back to this, our example, how much is the contract here? Anybody? How much is the contract? The contract is 50 million. So this is our transaction price. Our transaction price is 50 million. Is someone speaking? Okay, moving on. Now, after that, the 4th step is you allocate the price to the performance obligations. So, using our TechCo example, the transaction price was 50, but there are 2 performance obligations. They've not told us the exact breakdown of the cost that adds up to this 50. What they gave us was the standalone price. So if you are buying the software separate, it's 40 million. If you are buying the support separate, it's 20 million. If you add the 2 together, it's 60 million. But the contract price is 50. So what do? We allocate it. Simple allocation. Simple allocation. We will do 40 divided by 60, which is the sum of 40 plus 20, multiplied by 50. So that whatever we get there is going to be the price of the software. For the support will do 20 divided by 60 multiplied by 50. So that is what this step is simply saying. Allocate the price to the performance obligations. And finally, the last step is recognize the revenue when or as performance obligations are satisfied. This is very important. You recognize the revenue when or as performance obligations are satisfied. So if you receive cash for a service, you've not delivered the service, you cannot recognize revenue. You recognize a contract liability because you've not done the work yet. You've not supplied the goods. So you cannot recognize revenue. You recognize revenue when the performance obligation has been satisfied or as the performance obligations is being satisfied. So if it's a service, maybe you have a service to provide to a company for a period of 2 years. So you can break down the cost monthly for those 2 years and you'll be recognizing it month by month, right? So that is how you recognize revenue. So you recognize it when or as performance obligations are satisfied. So for me, the way I remember this is COPA. Contracts, step 1. Obligation, step 2. Price, step 3. Allocation, step 4. Recognition, step 5. Okay. So what does identification of contracts means? I know we've discussed it, but just to explain it again so that we understand fully. Because most times for SBR, you have to write, like you have to justify. So you will not imagine that the examiner know that, there's a contract already. No, you have to justify to the examiner why you want to apply IFRS 15. So what are the things that must be met? What are the criteria that must be met for you to say a contract is a contract or a transaction is a contract, right? That's what we are looking at here. So here you would see it. The contract does not have to be written. It does not have to be written. It can be verbal. It can be implied. You would know in the exam. If they give you the question, you would know if there is a contract. What I just don't want us to do is going into the exam and the examiner might put there is no written contract. And then because of that, you think that there is no contract. No. The standard specifically states that the contract does not have to be written. It can be verbal, it can be implied. So the criteria that must be met, the contract must be approved by all parties. So if there are 2 parties, it must be approved by both of them. 3 parties must be approved by 3 of them. The rights and payment terms can be identified. The contract has commercial substance, and it is probable that revenue will be collected. Sometimes, in a scenario that might be given, they might say, yes, there is a contract. This is the contract sum. The sum is 50 million. However, there is a 99% probability that the revenue will not be collected at the end of the obligation. In that instance, you don't recognize it because it has not met it. Because this criteria is not one or some must be met. All must be met. That's why I underlined this. All of them must be met. So it has to be approved by all parties. It can be verbal. It can be implied. The rights and payment terms should be identifiable. The contract should have commercial substance, monetary substance. And then it is probable that revenue will be collected. So that is the criteria for identification of a contract, whether a contract exists or not. So let's just look at this question. And here we just want to determine whether there is a contract or not. We're going to look at this same example till the end of IFRS 15 explanation, so that we are taking it one step at a time and seeing how all of the step works. So the first line, Smart Tech Limited signs a contract on 1st January 20X5, signs a contract, okay? So that means the parties approve with a corporate client, deliver smartphones, provide extended warranty, all of that. So here you can see that the rights have been established. Customer pays upfront in cash. It has commercial substance, right? There's cost, it has commercial substance. And what's the last one? It is probable that revenue will be collected. So that can be implied because they've not said anything that tells us that the money will not be able, we will not be able to collect the money at the end of the performance obligation, right? So here, is there a contract or not? So the answer is yes, there is a valid contract. So it meets the first step of IFRS 15. Now, step 2, identification of performance obligation. The different performance obligations within a contract must be identified. Okay, so when we looked at the first example, let's go to the first example about TechCo. We've identified here that there are two things that are being delivered: the software and the post-implementation support. Those are two distinct performance obligations. So that is what this step here is about. You identify the different performance obligations. If the goods or services that have agreed to be exchanged are distinct and different, then they should be accounted for separately. Don't bundle them up. So what the standard says is, if the different performance obligations can be sold separately. So if you have a question and they have given you stand-alone selling price, they've given you smartwatch, warranty, loyalty points, as in our example here, you already know that you should account for them separately. Don't bundle them up. So that in itself is a tip for you to say those are different performance obligations. However, in the standard, it says that if a series of goods are the same or substantially the same, they can be treated as single performance obligations. So if I'm to give an example, let's say they want to sell a good, maybe they have white wristwatch, blue wristwatch, just different colors, but the same product. In that case, the goods are largely the same. It's just the color that differentiates them. So you can treat them as one performance obligation. But if they are not, they are separately identifiable, they have standalone selling prices, please, they are different performance obligations and they should be accounted for separately. So looking at this, what are the different, how many performance obligations do we have? Can someone respond or type in the chat box, or so that I know we're together? How many performance obligations do we have? So look at the standalone prices. That already gives us a clue. We have 3 performance obligations. Thank you very much. We have 3 performance obligations. So let's just read it just to be sure. So it says to deliver 500 smartwatch at this price, provide 2-year warranty, and the bundle includes a customer loyalty program where client earns 1,000 points redeemable against future smart tech purchases. So 3 performance obligations, and that is it. We've identified our performance obligations. The next thing is to determine the transaction price. So the transaction price is the amount of consideration that the entity expects to receive in exchange for the goods. So the amount of what you are selling, the price of what you are selling, whether it's a good or whether it's a service, is what the selling party expects to receive. So using this our example, what do they expect to receive? Here we have 250,000. So that's our transaction price. But there is something further that the standard explains that we need to touch on. So when you're looking at transaction price, there are certain things you need to consider, 4 things you need to consider. The first is consideration payable, financing, variable consideration, or non-cash consideration. Now, these elements are ways that the examiner might want to test your understanding of the standard because they are not very straightforward. So we're going to go through them one after the other. Okay, so let's start with variable consideration. So variable consideration is when the amounts that you will get will depend on a future event. So for example, bonuses or penalties, right? So what the standard requires is that you estimate the amount that is likely to be received. They say recognize revenue to the extent that it is highly probable that you won't have to reverse it later. You have to always be prudent in recognizing revenue. So just a short example. BuildCo contracts to build a bridge for $100 million. If completed within 12 months, BuildCo gets an extra $20 million in addition to the $100 million. Historically, 70% of projects finish on time. What is the transaction price? So if this is a scenario that was given in the exam for this particular transaction, what do you think will be the transaction price? So we have 100 million, which is the normal contract price. But they've now introduced a variable consideration to say if they complete it within a year, they will get 120 million instead of just 100 million. So they said 70% of projects finish on time. Someone may want to assume that, okay, 70% is a good number. So that means they will receive the 20 million, right? And say 120. That the transaction price is 120, but that will be wrong. IFRS likes proportional allocation. So what the standard recommends is when you have a percentage, if they say 70% of the project finish on time, you multiply 70 by 20, the additional variable consideration. So 70% times 20 million, that will give you, where's my calculator? What is 70% times 20 million? So 20 multiplied by 0.7, that's 14 million. So at the end of the day, the transaction price that you will recognize in the books will be 100 million plus 14 million. That's 114 million. Are we clear? I'll take silence for yes. Okay, so we are clear. That's good. So that's variable consideration. The next thing we are looking at is consideration payable to the customer. So here, what they are saying is, sometimes when you give a customer a good or a service, and then you provide rebates, like a discount or a coupon to the customer, that would affect your transaction price. It will affect what you recognize as your transaction price. So that is what this is talking about, consideration payable to the customer. So the payable to the customer is discounts, rebates, coupons, right? Slotting fees. That's another example in the standard. So in case we see that in the exam, you see slotting fees, you know that it is a consideration payable to the customer. So it affects the transaction price. Because you are giving the customer back something, you cannot recognize the full amount. So using our example here, Soft Drink Co. sells beverages to a retailer for $500,000, but also gives the retailer a rebate of $50,000 for marketing displays. What is the transaction price? So here it's easy. You remove the amount payable to the customer. You remove that rebate you've given the customer. So here, the transaction price is $450. That's 500 minus 50. So it's $450,000. That is your transaction price. Okay. So next is non-cash consideration. Sometimes people pay for things with goods or with services. So there might not be money involved. And the standard doesn't say that there must actually be money. It just says that there must be commercial substance. So it's possible that the commercial substance there would be another good or another service. So how do you recognize it? The standard says that if the fair value cannot be reliably measured, that's the fair value of what is being exchanged, whether it's a good or a service. If it cannot be reliably measured, you use the standalone selling price of the goods or service exchanged. Example, a marketing agency provides advertising services in exchange for 10 laptops. So the marketing agency, they want to buy laptops, or they want to, the people who they are offering the advertising services to has told them that they don't have money, but we can give you 10 laptops if you run this advertising campaign for us. And they said, okay, let's do it. And in the question, it tells you the fair value of laptops is 20,000. So what is the transaction price here? If the fair value of laptops, if this 20,000 is for one laptop, you multiply it by 10 and you get 200,000, which is the transaction price. That is the price you would use. So if we see this in the exam, this is how we face it. Finally, significant financing components. So here, if the payment timing provides a financing benefit to either of the party, you have to adjust the price for the time value of money. So if maybe payments can be deferred for more than 2 years, 3 years, and the time value of money, the exchange rate, the market rate, sorry, is significant, then you need to adjust for it before you recognize it. You need to find the present value and recognize that in your books. So here they are also testing your knowledge of how to compute present values, right? So the example, Carco sells a car for $30,000 with payment deferred for 3 years, interest-free. So this 30,000, you won't pay it till after 3 years, but they are fixing the price today. Then in 3 years, you will pay 30,000. What is the transaction price? You cannot just put 30,000. You have to adjust for it because that 30,000 is not due today, it's due in 3 years. So you find the present value. So what's the present value? How do we calculate present value? Present value is the future value divided by 1 plus the rate raised to the power of n, right? The period. That is your present value. So our present value here is, our future value here is 30. So this is our future value. Our rate is 5%. The market rate is 5%, is given. And n, our number of years, is 3 years. So we calculate our future value. So when I calculated this, I got 25,900. Someone can calculate it for us and let us know if this is correct. 35,900. So that is what is going to be recognized as revenue. So here you recognize the car sale, 25, and you also recognize a financing arrangement. We'll look at that standard much later in another class. Okay, are we together so far? The class is too quiet. Okay. So back to our example. Smart Tech, what is the transaction price? So here it has told us that we are delivering 500 smartphones at a total price of 250,000. Did it mention any non-cash consideration? No. It says that customer pays upfront in cash. So there's also no financing components. There's also no variable consideration. So our transaction price is easy. Our transaction price is $250,000. All right. So step 4 of IFRS 15, identification of revenue, is to allocate transaction price. So in the first instance, we have our three performance obligations. We determined that there are 3. We've determined that the transaction price is 250, and now we have to allocate our transaction price. So let's go to our Excel. Okay. Okay, before we solve the other question, let's complete the first example that we have. So remember we had TechCo we were solving and we stopped at application of IFRS 15. So now that we've covered IFRS 15, let's look at it. Is there a valid contract? Yes, because it says TECO enters into contract with a customer. So yes, there is a valid contract. Yeah, that's not clear enough. Let me use black. Okay, so there's a valid contract. The second step is to identify your performance obligations. And we already identified that they're providing a customized software, and they're also providing support, right? So let's take it one by one. So the first one is identification of contracts. So under application of IFRS 15 section, you can put it in steps. You can break it down so that the examiner knows that you understand what you're doing. You can say contracts. For example, there is a valid contract, or you can put TECO to have that link, between your answer and the question. TECNO entered into a contract, or into a contract with a customer to deliver X, Y, Z. The contract has a commercial substance and is valued at 50 million. Now, the essence of typing this into your response sheet is to let the examiner know that you know the criteria that must be met before a contract is judged a viable contract under IFRS 15. So this already tells the examiner that, okay, I know what I'm talking about, right? So that is one. Two, performance obligations. So you put here the contract has two separate performance obligations. One for the supply of a customized software system, and another, you can word it just in a very clear, simple way that is not too cumbersome to read and will not take your time. And another for post implementation support. Okay. So number 3, is to know what the price is, right? Transaction price. So in here, the transaction price is 50 million. There is no cash, non-cash. Okay, so the transaction price is 50 million. So next, we are going to allocate it, right? Okay, so let's listen up here. In your SBR exam sheet, we'll look at it in detail some other time. So look at what the sample response sheet looks like on the ACCA website. You can check the ACCA practice site. Usually you would have Microsoft Word and you would have Excel. So if you are to do any workings, you can do it in the Excel and just reference it to your Microsoft Word. Because now we want to allocate the transaction price. So instead of us now writing 50 divided by bracket 40 plus 20, you know, it's very clumsy. It's not professional. You don't do that. What you do is you go to your Excel. When you go to your Excel, you can, let's create a sheet. You can name the sheet because there will be an Excel for each question. So you can name the sheet workings. So let's name it workings tech co. This is professionalism. It can get you professional marks even if you lose it somewhere else, right? So we are calling it workings tech co. So what are we working? Make sure you always have a title to your working. What we want to calculate is allocation of transaction price, right? That's what we are checking. And what are we allocating it against? The performance obligation. So put a heading, performance obligation. How are we allocating it? With the standalone price. Another heading, standalone price. And what are we trying to get at the end of the day? Allocated transaction price. Yep. In one of the examiner's reports, I've forgotten the specific one. One thing that the examiner complained about is that there were no headings. So sometimes they don't know what the student is calculating. They cannot reference it, you know. So it's usually very, very cumbersome. And then, least I forget. So sometimes when you open a sheet like this, if you have a big question, there may be different things that you will need to work out, different things that you need to calculate, right? What you can do is for each, let's insert a row above this. Or in this, our title, just put working one. So working one, this. If you have another working, you just come below working two. Calculation of cost price or whatever it is, right? This is just an example. Example. So this way, it's neat. Your workings is very neat. The examiner knows what you're doing. So what are our performance obligations? We have software and support. The standalone price for software is 40 million, for support is 20 million. Okay, so we come here, we say software, customized software. The standalone price is 40 million, right? So up here, let's put million of dollars. So we put dollar sign and we put M. So the examiner know that what we mean is dollar and million. So you always have to imagine yourself in the office, in the office environment. So if I'm presenting this to the MD or to the board, you know, how do I put it? How do I arrange it? You have to do it like that. So the second performance obligation is support. Let's say it, let's call it what it is, 2-year post implementation support, right? That is our second performance obligation, and it's for 20 million. So the total of this, you go to this plus this is 60. So this is what we are going to allocate. right? So we can put it somewhere. The allocation, the transaction price. What is the transaction price of the contract? Is 50 million. So is this 50 million that we are allocating, right? So let's put it up here. Transaction price, or no, contracts price equals 50. So since we're putting it in just 50, we need to put our dollar and million. So the reason is there is because we're going to link it in the calculation. Everything has to be linked. If not, the examiner will not know what you're doing. So what we are doing to allocate is we're taking the standalone price of each of the performance obligation. We'll divide it by the total, which is 60. And then we multiply by the transaction price. To be sure that we are going to be correct, let's put brackets in the first ones, because we want to first of all do 40 divided by 60, then multiply by 50. So for the first one, we have 33333. Then we do the same thing for the second one. 20, let's open our brackets. 20 divided by 60 multiplied by the contract price of 50. So we have 16. So let's check if we're correct. If we do 33 plus 16, we have 50. So this is our allocated transaction price, right? So we can round it up, rounded as 33 and 17. If we add it up, it is 50, right? You can round up in the exam. It's not anything. Okay, so now we've allocated the price, right? We come back to our Word document where we are typing our answer, and we put in there allocation of performance obligation. Please write in full in the exam, don't write PO. Allocation of PO. So you put in brackets workings 1 in Excel sheets, right? And then you can now put according to the calculation in relation to the requirements of IFRS, the costs, the transaction costs have been allocated to the software, 33 million, and the post-implementation support, 17 million. You can still add, instead of putting it up, you can put it down. See workings 1 in worksheets for the calculations or for details, or you can just leave it as see workings 1 in worksheets, and you are fine. That is it. So the last thing is the recognition, right? So how do we recognize this? The cost of the software, you recognize it when, remember the requirements of IFRS 15, you recognized when or as performance obligations are being settled or are being delivered. So you put it that the customized software, in brackets, 33 million, or the value of the customized software should be recognized when the software is delivered to the customer. Or to make it more, to relate it more, instead of saying the value, you can just put TechCo should recognize the value of the customized software when the software is delivered to the customer, because this shows that you are relating it to the scenario. The costs of the 2-year post-implementation support should be spread over the 2 years and recognized as the obligations are being fulfilled. So you can put the cost of the post-implementation support in brackets. And we calculated that to be 17 million, right? So that's what we have here. Any questions? Okay. I believe there are no questions. So the next thing that we are going to do is to conclude. So we've not answered everything. Yes, we've answered, back to the requirements now. We've answered the reference to the conceptual framework is right here. IFRS 15, that's what we've done here. Now they've asked how should the revenue be recognized. So we're going to put that in our conclusion, or if you like, you can name it recognition, but we've already spoken about recognition here. But this conclusion, we can put the accounting treatment. So in the conclusion, it's going to be, you can repeat what you've done. You can repeat what you've done here to say they should recognize just in another language, or you can say something else. So here, let's say the company, TechCo should recognize, okay, let me just leave it at the same thing, right? Let me just leave it at the same thing, but you can reward it in the exam. Just give a closing statement, or in here, in addition to what you have here, you can put just a statement to faithfully represent the costs of obligation fulfilled within the year. So you are linking it to the conceptual framework. You are telling them why they should recognize it immediately, right? So it adds a bit of professionalism to your response, and it doesn't take a lot. Meanwhile, this one, it should be spread over 2 years. Why? Why should it be spread over 2 years, right? So you can add here that the costs should be spread over 2 years using a straight line method. So they'll just divide that cost by the number of months and be allocating it. A straight line method to faithfully represent obligations as they are delivered and within the relevant period. Okay. So we finished. Okay, this is too small. We finished that answer. So if issue had 1 mark, application had 2 marks, IFRS had another 2 marks, that's 5 marks. Okay, this one is 2, let's say 4 marks here, right? So that's 4, 5, 6, 7. And maybe your conclusion would have 2 marks. I'm sure there will be other marks in between. maybe for professionalism and all of that. So for putting headers, for arranging your workings, for your workings being, very arranged and straightforward, you get another additional mark. So that is how you structure your typical response for SBR examination. Most times, if you look at all the past questions, you would see that it's usually just small scenarios within the larger questions that are given, and they will tell you, discuss this, analyze this, how would you treat this? So this is what you will need to do. You will need to briefly state what the issue is. You will need to apply the framework or the standard, right? If you don't know the standard, make sure you apply this framework. If anything fails you in the exam, please don't forget relevance. Don't forget faithful representation. If it doesn't faithfully put it there, it does not faithfully, and always use that word, faithfully represents, because that is the word of the framework. That is the work that you would even see in almost all the standards. So you put it there that it doesn't faithfully represent because you put the reason. You understand? So that is how to answer questions for SBR. No matter the standard that we are going to study together, no matter the standard that will come out in the exam, you will need to defend whatever it is that you are putting in there. Okay. Are there any questions at this point? Okay. So if there are no questions, we'll go straight to the question 2 that we were working on. So here, we are just going to do the allocation. We're going to do the workings and discuss the other elements, right? So that we save time and we can cover the remaining of the standard, the things that we need to explain under IFRS 15. So we've determined that there are 3 performance obligations. So workings, let me make this a little bit bigger. Okay. So workings, performance obligation, let me write it in full, performance obligation, standalone price, and then allocated transaction costs. Right? Okay. So let's reference the transaction price somewhere. Let's put it up here. Transaction price is equals to 250,000. So our first performance obligation is what? The delivery of smartphones. So this is the question here. So what is the standalone price for smartphones? So it has told us that the standalone selling price for smartphone is $450 each. And how many smartphones did we buy? 500. So you say 500 multiplied by 450. Right? So that's for smartphones. The next thing we have is warranty. So for warranty per phone, they said the warranty per phone is $50. And how many phones are we buying, or are they delivering? They're delivering 500 smartphones. So that is 500 smartphones multiplied by $50, which gives us 25,000. And the last performance obligation is loyalty points. So loyalty points, they've already estimated the fair value at $10,000 total for everything. So these are the standalone prices. So the sum of it, you say equal to sum open your brackets and highlight everywhere that you want to add, close your brackets. So the sum of our standalone prices is 260,000. So we have to allocate this to a transaction price of $250,000. So we come here, equal to, for smartphones, we pick the standalone price for smartphone divided by the total of the standalone prices. Let's not forget our brackets, just to be sure, multiplied by the transaction price. And we do the same thing for the other performance obligations. Okay, so let's sum this up to see whether it adds up to 250. Yes, it does. So we have individual allocated transaction cost. So we've allocated everything. Okay. Are we together? Are there any questions at this point before we go back to our presentation? Okay, if there are no questions, we would continue. All right, so we've solved this question. So we wanted to see how to identify our transaction price. And we've done that for that example. So the last step is recognition of revenue. Revenue, like we said before, is recognized when the entity satisfies a performance obligation. When or as the entity satisfies a performance obligation. So it can occur either at a single point in time, like when you are delivering a good, a physical good, or over a period of time, like when you are performing a service. Or maybe you are delivering goods in tranches, in milestones, you know? So if a performance obligation is satisfied at a single point in time, we should consider the following in assessing the transfer of control. 1, the present rights to payment for the assets, transferred legal title, transferred physical possession, transferred risk and rewards, and if the customer has accepted the assets. If these have been met, it means that the control has been transferred to the buyer. So sometimes you might see a question where they will say, company A sold a product to company B. Maybe company A has invoiced company B, or company B already has rights to pay for the assets. They've transferred the legal title. The customer has accepted the asset, but for some reason, the asset is still in possession of company A. So in that instance, will you recognize the revenue? You will, because the right for the payment of assets exists. They've already transferred legal title, transferred physical possession. Sometimes maybe they've not transferred the physical possession, but it is for a reason that the company is causing, not the person that is supposed to deliver it to you. You've transferred the risks and rewards, and the customer has accepted the assets. So once that asset is yours, you recognize the revenue. Okay. So when a company performs a service over time, there are two methods that the standard recommends. So we either use the output method or the input method, right? So you can also use a straight line method like we did in that the other example we looked at. However, if in the scenario that is being painted in the exams, you see that they've provided work certified to date. They provided some certain information that would help you to use the output method. You can use the output method. If they've provided cost to date and the total estimated cost, you can use the input method, which is cost-based. So depending on the information provided, the thing is, most of these things are very logical and they're very common sense. So just think about it like that. So you read the scenario, you look at the examples that's been given, and you use that to recognize or to allocate the costs given over time. If nothing has been provided, if no information on work certified to date, cost to date, if they have not been provided, you can recommend a straight line method, right? So, and you can justify the reason why you are recommending a straight line method. You can say the revenue should be recognized on a straight line basis, as the service is expected to be provided equally throughout the years of the contracts. You know, that helps the examiner to understand that you know what you're saying. You are not just recommending it just for the thought of it. Or even if the information is not given and you feel like a straight line method will not adequately or faithfully represent the information on the financial statements, you can say that the revenue should be recognized over time based on work certified to date, to ensure that the amount represented faithfully represents what has been delivered to the client or to the customer over time. You understand? So that gives you, and that tells the examiner that you know what you're saying. You've looked at the scenario. You know that straight line won't work here, and but this would work. That would gain you professional marks as well. Okay, so we've allocated the costs, we've answered this question already. So if we are to recognize it, what debits and credits are we going to pass? So for the smartphone, when it's being delivered, okay, first of all, it says that customer pays upfront in cash. So let's say today the customer has transferred $250,000. What do? We debit cash and we credit contract liability. We're not crediting revenue yet because it says it's paying upfront. So we're assuming that the products have not been delivered yet, right? Okay. So we debit cash and we credit contract liability. When the smartphones are delivered, what do? We debit the contract liability to reduce it with 216. Remember, when we did our example, we got 216,000, and you credit revenue, you recognize the revenue when the contract is delivered. So let me go back to the Excel and put it side by side so that we understand better what we are doing. Okay. Accounting entries. Upfronts, cash payments. You debit debit cash, credit contract liability with 250,000. So for the smartphone, when delivered, you debit contract liability, and credit revenue, smartphone with 200. Let me just put the value here. So this is the value we're using, 216. Okay. For the warranty, so what do we do? How do we recognize the warranty? The warranty is per phone for 2 years. So it's an extended 2-year warranty, right? So we have to recognize it over the 12 months. Most times, financial statements are for 12 months. So, to be recognized over 12 months, we can't recognize the full amount here. So we debit contract liability and credit revenue warranty. So always specify the revenue leg. So this 24 is for 2 years. So we're dividing it by 2 because we want to know what is going to be for 1 year. So for 1 year, it's going to be 12, right? So we're going to have that 12. Okay, this stops the pops. Okay. So for the loyalty points, how do we recognize loyalty points? So for the loyalty points, same way, you recognize it when the loyalty points Hello, can you see my screen? Okay. So for the loyalty points, you recognize it when redeemed. And you're recognizing 9. Okay. Okay. So that's all for this question. But remember in the exam, to always present the issue, to link it to the conceptual framework, and to the standard to be able to get full points. Okay. Okay. So there are other, if you look at the nature of questions that come up during the exams, sometimes you don't see straight jacket revenue questions. Sometimes you see things on principal and agents, you see things on warranties, you see things with repurchase. So how do we treat those things? So first of all, let's look at principal versus agents. So what is principal versus agent? So principal is someone who provides the goods and service by themselves, right? In itself. Agent is if you get another person to provide it, right? That's agency agreement. So that's the principal and agent. So you have to determine this person in this scenario, or this company in this scenario? Is the person a principal, or is the person an agent? Because it would impact how you would recognize the revenue, whether you will recognize the revenue gross or whether you will recognize the revenue net. So what do I mean by gross? So if, for example, someone is delivering electronic devices, or someone has a contract to deliver electronic devices, and the person buys that device from someone else to deliver it, right? Will the person recognize the gross fee or just the commission for the sale? I don't know if we understand. We're going to look at an example on it. We're going to look at, let's leave it and just look at the example on it. So what are the indicators to determine whether someone is a principal or someone is an agent? So to determine if someone is a principal, you check who has the primary responsibility for fulfilling the contract. If it's the company, okay, that's one thing checked. Who has the inventory risk before and after? And then number 3, who has discretion in setting prices? So if you look at all of this, it is likely a principal. If these 3 things are absent, then the company is likely an agent. So let's look at as an example. We'll just talk through it because we don't have much time left. Okay. TechMart operates an online platform for selling electronic devices, just like Jumia, right? So the customer buys a laptop on the TechMart website for 1,200 and TechMart pays the supplier 1,000. So the person who actually owns the laptop is someone else, is the supplier. But if a customer wants to use TechMart's website, the person will buy the laptop for 1,200 and then the TechMart would pay the supplier 1,000, which means that TechMart's commission is 200, right? So is TechMart the principal or the agent based on this? Let's look at the terms. TechMart sets the final selling price. TechMart handle returns and warranty claims. TechMart does not hold physical inventory, but the laptop is shipped directly from supplier to customer. TechMart's accounting team is unsure whether it is acting as principal or agent. So you have to determine. So requirements for 20 marks. Apply the IFRS framework to determine whether the IFRS 15 framework to determine whether TechMart is acting as principal or agent. B, show how the revenue should be recognized in each case, including journal entries. And C, explain how the conceptual framework supports the correct treatment. Okay, so let's talk through A. How do you apply IFRS 15? What is the framework? So this is it. A principal is someone that controls the assets, the good or the service before transfer to the customer. Agent does not control, but he earns a commission. Also, the indicators that we have here. Primary responsibility for fulfilling the contract, inventory risk before and after, discretion in setting prices. So let's go back to our example. So who owns the primary responsibility? Here, it already tells us that TechMart sets the final selling price, which is one of the indicators of being a principal. It also tells us that TechMart handles returns and warranty claims, which is also one of the indicators to suggest principal. So it says that It does not hold physical inventory. However, because it handles returns, it handles some risks, since it is TechMat that handles returns. So it also supports principal, right? So we can conclude that TechMat is a principal. So in answering this question for 10 marks, you define what a principal is, you define who an agent is, and you now say, okay, in this case, based on the indicators as stated in IFRS 15, TechMat sets the final selling price, which suggests principal. In addition, TechMat handles returns and warranty claims, which indicates inventory risks, which also suggests principal. Although TechMat does not hold physical inventory, since TechMat has responsibility for returns by the customer, it also supports principal because it suggests some risks are borne, some inventory risks are borne by TechMat. So you write that down to support whether TechMat is principal or agent. So you put in your conclusion there. You put in your conclusion to say TechMat is acting as principal in this case. Okay? So B, show how revenue should be recognized in each case, including journal entries, right? So if TechMat was principal, so what this question means is, if TechMat is the principal, how should revenue be recognized? If TechMat is the agent, how should it be recognized? If TechMat is the principal, how should we recognize the revenue? For principals, you recognize gross. So you can put a small note to say revenue should be recognized gross for principal arrangements. Or you can put, since TechMat is the principal, the revenue should be recognized as gross. So what that means is you debit your revenue 1,200, that's the cost of the laptop. You credit cost of sales 1,000, and your gross profit is 2,000. Because what this means is, if you say someone is principal, it's almost as if the person is the one selling it directly. So you are selling your product. Your profit is going to reflect in your gross profits. It's not going to be like commission anymore. So you recognize the full gross revenue of 1,200 that the customer pays for the laptop. You credit your cost of sales with the amounts that you're going to pay your supplier, right? And then the balance is the gross profit of 200. That will be there. So you debit cash or receivable 1,2, credit revenue 1,2, you debit cost of sales 1,000, and credit payable to supplier 1,000. So those are the journal entries that you will write there. So you put below, since they've asked how revenue should be recognized in each case, you said if TechMat is the agent, only the commission earned should be recognized. Therefore, commission of 200, which is, you can put in brackets 1,200 minus 1,000, should be recognized by debiting cash or receivable 1,200, because the customer will still pay to TechMat. Then you credit payable, not cost of sales here. You credit payable because you are debiting cash or receivable from the customer. You are crediting payable, and then you credit, you're crediting payable 1,000, and you credit revenue 200. Are we clear? Okay. So for number C, explain how the conceptual framework supports the correct treatment. So again, we go back to relevance, faithful representation. So for relevance, you can put there that you can say users need information on total sales volume and not just commission. Why? To evaluate TechMart's market activity. So think of it this way. Imagine TechMart is Jumia, for example, right? And imagine that you are an investor with Jumia. Will you only want to see the commission that they get on each sale they make? Or you want to see the full activity, the sales volume? What have we sold this year, right? If I was an investor, I want to see what have we sold this year. Then I will now relate that to the commission so that I will even know whether I'm adding sufficient prices, on my cost, on my inventory that people are selling on my website. So you put relevance. So you put, okay, relevance to what? The users. Users will need to see information on total sales. Therefore, it is important that a gross representation is included in the financial statements. Faithful representation. So, if you recognize just commission for TechMart, how does it represent the returns and warranty claims? How does it represent the risk that it bears in terms of customer returns? How does it show that TechMart sets the selling price, that it controls the price? It doesn't show because it's just a commission. But if you can see the gross, you know that, okay, it means that there's some kind of risk that we are bearing for the inventory, because people return things that they buy online, and you don't return directly to the supplier, you return it directly to TechMart. So to faithfully represent it, recognizing the gross revenue of 1,200 with the cost of $1,000 better reflects TechMart's performance, since it controls the pricing and bears warranty obligations, bears returns and warranty obligations, right? Also, substance over form. Now, what is the substance, or what is the form? The form here is that they've said TechMart does not hold physical inventory. So the physical inventory is with the supplier. However, if a customer places an order for the good, TechMart will just tell the supplier, deliver this. So who actually controls the inventory? It's TechMart, right? So substance over form also applies here. So you say even though the inventory is not physically held by TechMart, TechMart still controls the goods in substance, right? So you type that out and you gain your full marks. Please, if you have any question, you can stop me, you can ask, or you can put it in the chat box. Okay. So the next thing that examiners like testing when it comes to revenue are repurchase agreements. Sometimes when a vendor sells an asset to a customer or a good to a customer, they would put an option to repurchase the assets. So they will say, okay, I will sell you this equipment today for 100,000. Okay, there's even an example. Let's use the example. Equipco sells equipment to a customer for 100,000. The contract includes a forward agreement where Equipco will repurchase the asset in 3 years for 110. Useful life of assets is 10 years. So it's saying that Equipco is selling, but Equipco will repurchase the assets, not has a right to, it will definitely buy back the asset in 3 years for 110. Is that a sale? Should that be revenue? That is not revenue. That is just like it's a liability. It's almost as if they borrowed, they leased out the assets or they borrowed it out. So it's a financial liability. And that additional 10,000 on the 100 is like interest. So I'm giving you this equipment for you to use for 100, but it will be repurchased for 110 in 3 years, right? So the customer has effectively borrowed Equipco 100,000, and Equipco will pay back the customer in 3 years 110, which is the original cost of 100 plus an interest of 10. So in here, IFRS 19, IFRS 15 will not apply. So the fact that the question or the scenario says sales doesn't automatically qualify it for IFRS 15. So in this case, what accounting entry will you pass? You will debit cash. At inception, when you sell, you debit cash because money would come in, right? So you debit cash and you credit financial liability. Financial liability. And then each year, you recognize your finance expense. Okay. So an exam tip for repurchase agreements is to always look at who controls the assets. You also look at if the repurchase is expected. If it is highly probable that they will buy back the assets, then you don't apply IFRS 15. So you then have to think about the substance, whether it's a lease or a loan. Okay? So another scenario, retail co sells equipment for $50,000. The customer has the right to sell back to retail co within 2 years for $45,000. The expected market value after 2 years is $40,000. So the repurchase price is greater than the market value. So buy back for 45. The market value is 40,000. Right? So the customer is likely to exercise the option. So here, is this a lease or is it a loan? Because it's as if the customer is using it. So retail co is the person selling the equipment for 50,000, right? And the customer has a right to sell back to retail co, to return the assets back to retail co. So it's a lease. So you recognize it using lease, using the standard on leases, right? What will you do? Or how would you recognize this same transaction if the expected market value after 2 years is 60,000? Now, the reason why the customer will be comfortable to sell back the equipment to retail co is because the value is less. The expected market value is less. But if the market value after 2 years is higher, what would happen? Okay, so lastly, the last thing that we are looking at today is non-refundable upfront fees. Non-refundable upfront fees. So sometimes you see examples, some questions that have membership, club membership, or gym memberships, and there's always an upfront fee. So how do you treat that? That upfront fee, you can't tie it to a number of years. Like it's something that just has to be paid. So how do you recognize it? In some contracts, you see an entity charge a customer a non-refundable upfront fee at or near contract inception. Examples include joining fees in health clubs, You know, when you go to set up, when you go and join the gym, there's always that upfront fee that you have to pay. If it's a separate performance obligation, how will it be treated? So let's use an example to explain it. A gym charges $100 non-refundable joining fee and $50 monthly membership fee for 12 months. How should the gym account for the $100 joining fee? Okay, so what do we do? Here, that $100, is it used up once, or is it supposed to cover like the duration, the entire 12 months that you're using the gym? It's supposed to cover the entire 12 months. So you cannot just recognize the revenue at once. You have to recognize that joining fee, non-refundable joining fee of $100 over 12 months along with the monthly fee. That way you would faithfully represent it. If you just recognize it once at the beginning of the year, it doesn't really speak to what that fee covers. Usually upfront fees might cover maintenance of the gym, maintenance of the equipment, and all of that. Excuse me. So recognizing it upfront doesn't faithfully represent what the money is being used for. So in this case, what do? You have to spread it out. So you can use a straight line method to recognize it. So what you do is 100 divided by 12, and you recognize it going forward. So at the initial, when that $100 is paid, you debit cash, you credit contract liability. And then each month when you recognize a portion of it, so you divide that 100 by 12 and then recognize it each month. You debit contract liability and credit revenue with the monthly amount. So that is all for today's class. Thank you for your time. Thank you for your attendance as well. I appreciate the engagement, the little engagement I got today. Are there any questions at this point? If there are no questions, we have come to the end of today's class. Let me check the chat box. Okay, I can see a comment from Issa. How will the membership fee be recognized? So to recognize the membership fee, when it's paid, when cash is received, let me type it out. You debit cash upon payments. Okay, you debit cash and credit contract liability with $100. Then on a monthly basis, let me do the calculation. On a monthly basis, you recognize a portion. So that $100, we're going to divide it by 12. We're spreading it. So 100 divided by 12 is 8.33. So on a monthly basis, you recognize the membership fee. So let me just put monthly. You debit contract liability and credit revenue, upfront fee with 8 $1.33. Okay, I hope I've answered your question, Isa. Okay, thank you very much. I'm just seeing some of the chats in the box. Okay, so thank you, everyone. Are there any more questions? Are there any more questions before we close today? SBR honestly is one of the easy courses to pass because the new knowledge that you have to get is very minimal. It's something that you already know. You already know it. So it's just to apply it. Don't assume that the examiner knows what it is. Explain it as if you are explaining to your MD. You know, if you're working in a workplace, the MD might not be an accountant. So the MD doesn't know what IFRS is. The person doesn't know what the conceptual framework says. So that is the way that you have to explain it. The MD might not even know the issue. So the MD might just say, okay, we have a transaction, this, and this is, recognize it and revenue. And then you now go, you say, no, we can't do that. If we do that, it's not going to faithfully represent it. You have to use that word faithfully represent because it's an exam. Of course, you won't use it you may not use it in a work setting, right? You may want to use words that is easily understandable, but because it's an exam, you have to use those specific words from the standard. So you put it there that, no, we can't do this because it will not faithfully represent it. We have two distinct performance obligations. We can't bundle them out. We have to figure out how to recognize it. And then MD will say, okay, explain it to me, write me a report. What do you think we should do? And then you have to go back and you sit down and in your reports, you know, you have to have an introduction. You put the introduction there, even though the MD knows what it is, you have to put it there again. You have to state it. You say that the company entered into a contract with this. The issue with the contract is that XYZ cannot be bundled up. You put it there. Then you now put application of the conceptual framework. According to the conceptual framework, that this is how it should be treated to ensure that information is relevant, faithfully represented, and all of that. Then you put the debits and credit. You put the specific standards if you know it, or you try. The thing is, you might be correct. Most times, the good thing about the exam is that they will put the standard for you there. They will say IFRS 9, they will say IFRS 15. So even if you are not sure that that's what IFRS 15 say, as long as it makes logical sense in relation to the conceptual framework, you put it there. Put that, yes, according to IFRS 15, revenue should be recognized when the performance obligation has been met, even if you forget the 5 steps. You know, you just put it there. Put something that will make the examiner feel that you know what you're talking about, right? You put it there. And then you explain it logically in a way that it makes sense. Make sure it's professional. Put headings. For all your headings, you can put it in capital or you can make it bold. That provision is in the exam. Make it bold. Put the section. Put your conclusion. In the workings, when you are sending something to your MD, you don't just scatter your workings anyhow. You have to arrange it so that it makes sense, right? So you arrange your workings logically and then you send it and you get your points. So at the end of the day, based on the solution that we have, let me share that screen again so that you get an appreciation of how SBR is being marked. So this example that we looked at now, the workings that we did on this techno is just this. So at the end of the day, it is not this that will earn you your full marks. It is not the debit and credit. If you just go and you put debit, credit, cash, credit, revenue, you won't get any full marks. What gives you marks is what you write. Remember, at the beginning of the presentation, let me share the presentation. Okay. So at the beginning of the presentation, when we're looking at the examiner comments on the topic, we saw that more marks will be allocated to written answers than numerical answers. So you need to consider that, focus on that as well. I'm not saying you should forget about the numeric and the debit and the credit, but what I don't want you to do is to downplay the written form. If you really want to succeed and get all the marks that you can get, please let us give detailed answers during the exams. Thank you once again to everyone. I appreciate your participation and have a lovely weekend. Thank you.